Hello, my dear friends. This is your friend Vivek Bajaj, co-founder of StockEdge and Elearnmarkets. Friends, very excited to record this face-to-face. The guest today is unbelievable. If you are a serious finance professional or someone who understands finance very deeply, you must have read his books. He is an authority on the subject, and what he talks about related to companies and valuation is considered to be a serious talk. Yes, you must have guessed it right. My guest for this face-to-face is none other than Aswath Damodaran. He's a great personality. I have heard him so many times. I'm a regular follower of him via his YouTube channel, and his clarity on the subject is commendable. I am sure this face-to-face I will be able to get the maximum out of him for you so that we understand this complex science of valuation in a much simple language. Looking forward to interact with him. I hope you like this interaction. So welcome to this face-to-face conversation. It's such a delight and I'm so excited to be interacting with you. You have been the one who have laid the foundation of V for us. V stands for valuation. So thank you so much for taking time out and interacting with me.
You're welcome. Glad to be on.
Thank you, sir. Sir, I want to start with the more placid question or the concern which most of the old school investors like me have right now is there are new generation guys who have come into the market and they're looking at the price, right? And they're speculating in the market thanks to Robinhood, thanks to Zerodha in India. And we can't blame them for that because they find more excitement in those things. And millennials definitely have more propensity to get excited. So where is the whole concept of valuation in the stock price? And is that still relevant? Because the new gen company which are getting listed, there's no profit. There is no scope of profit in near future. So can you please help me decode the science of valuing the new gen companies?
Let me first push back. You said you're an old-time value investor, right? How many old-time value investors actually value companies? Maybe 1 in 100.
Yeah.
When you say old-time value investors, I think Ben Graham, Warren Buffett, most of them don't value companies. They price them. They price them based on price earnings or price to book, and yet all these little screens you ran, pick stocks with low PE ratios. Nobody valued companies. So when people talk about, we used to value companies, I call them as liars. And I'll go to Omaha and say this to the faces of all of those portfolio managers show up there. They've always been pricing companies. You know what you're finding difficult is your metrics don't work on the companies that are out there now. What do I mean by that? A price earnings ratio works for a nice mature company. You're valuing a ITC or you're valuing a Britannia. Basically, you can take even the Infosys is the word, which are more mature companies. Price earnings ratios work. But if I come to you with a young company with lots of growth and potential, potentially a valuable company, but that's not making money, your metrics don't work. So it's really not old-time value investors who used to take care and think about the business and invest. And let's face it, 90% of markets have always been trading. The only problem is old-time value investors traded on PE ratios. Those metrics don't work. So now they're very busy wagging their fingers at young people saying, you lazy, shallow people, you're buying stocks you shouldn't be buying. But let's face it, the laziest people I've seen in the market are old-time value investors. Lazy because they have these screens that have passed down through time. Buy stocks with PE ratios less than 15. Ben Graham actually listed 12 screens. It's amazing how much of old-time value investing is stuck on those screens. So first, let's dispense with the notion that in the old days, people used to be careful and invest, and then now people are shallow. It's just in the old days, people use pricing metrics like PE ratios, and then these days, people use pricing metrics like price per user, price per subscriber. I'm not sure one is better than the other. They're both pricing. So first, we've got to remove this aura of superiority that older investors have over younger investors, that this is part of growing old. You always think people are younger than you, got things much easier than you did, work less hard than you did. And I think the minute you adopt that attitude, you stop being able to learn from what's going on around you. So I don't view the market as being less sensible or more sensible, less value driven or more value driven. It's just driven by different sets of metrics now than it was 20 or 30 or 40 years ago.
True. So because you have been in market for so long, so this narrative which I just uttered, every time market goes in an extreme bull run, you will hear this narrative. In 2000
you
also,
heard it from the people who weren't part of the bull run. Have you noticed that? That's the other feature of markets is people who are not in the stocks that went up the most always look for excuses that don't involve themselves.
Yeah.
Right. And I think this is a very easy story to tell if you're a value investor and you've been sitting out the market and you haven't got the big winners over the last decade. Rather than look inward and say, what am I doing that is keeping me from buying these big winners? You look at what are they doing to make money so easily? And my problem with that is if you don't look inward and say, what am I doing that's causing me to miss these winners? You're not learning. You're not adapting. Markets have always been changing.
Right.
This is not just in the last 20 years. You can imagine how much of a change there was take India, 1960 through 1980 stock market versus 1980 through 2000. That was an even bigger quantum shift than what you've seen between in the last 20 years, because markets are constantly changing. And if investors and traders don't change with them, they're going to fail.
Sure. So, sir, I want to talk about two category of investors. One are the pre-listed investors, the unlisted investor who value businesses in a very different manner. And we have seen examples in India where till the company was listed, the valuation was going up, and suddenly after listing, the valuation has crashed. And there's a second category of investor who is there invested in a listed stocks. Can you please, take us through that mindset of both the investors, because their perception of value would be very different for an unlisted stocks and for a listed stocks?
So you're talking about like people like venture capitalists and investors in private companies?
Yeah.
Again, I'm going to push back. How do venture capitalists put a price on a company? They look at a metric just like public investors do.
Yeah.
Price per user. And in fact, it's interesting that your point, there's almost a conspiratorial component to your story, which is private investors push the price up, they take it public, and then the price collapses.
Yeah.
Right? You're letting Paytm drive too much of your story, right? The reality is, if you look at IPOs and you look at post-market performance, what happened at Paytm is more the exception than the rule. People have become rich on company. What if you think about Facebook? Facebook went public, I think, at $30 billion market cap. It's now a $500 billion market cap company. What do public market investors have to complain about? So first, this notion that private market investors use different metrics than public market investors is not true. And it is true that they have this advantage of timing, which is they can see when things are shifting under them and maybe go public first. But for the most part, private market investors are no different from public market investors. In fact, in the US, the distinction is almost gone. Uber, before it went public, was already receiving investments from T. Rowe Price and Fidelity and from endowment funds, which are public market investors. Right. The Saudi sovereign fund invested in Uber before it went public. There's this gray market now where public market investors invest in private companies. The transition has actually gotten a little smoother because of that. That doesn't mean every IPO is going to go public and then soar. I think the problem, though, is when you're greedy, you're going to overreach. And that's true for private market investors as well as public market investors. And when times are good, you get greedier and greedier, and you get lazier and lazier. Because what happens is it becomes too easy to make money. And we've come off a decade where it's been easy to make money. I mean, what's the rule you've learned, right? And if something goes down, it always comes back up. It's worked pretty well. Think of how well it worked during COVID, right? Imagine buying stocks in March or April of 2020. I think when you fall into those bad habits, you stop asking questions. And I think this is not just true for young investors. All investors collectively get lazier. Private market investors, public market investors. And I think that one of the things you have to, markets always do is they bring people back down to earth. It might not happen this year, it might not happen next year. But I think of this as markets essentially saying, be humble. Arrogance is the most dangerous quality to bring to markets, because when you think you know more than the market, when you think you're smarter than other investors, when you think you do more homework than everybody else, you're essentially setting yourself up to be taken down by the market.
Right, sir. Sir, let me go slightly more academic here and discuss with you the process of valuing this new businesses, right? Where you just mentioned that, price per user and lifetime value of the user, etc. These are the key matrices. We have read your books and we have talked about the earlier matrices, which are like more discounted cash flow and PE, etc.
No, the earlier metrics were not discounted cash flow. I mean, I want to dispel this notion that investors have used discounted cash flow in investing.
Okay.
I can't think of a single portfolio manager in history who's picked stocks based on discounted cash flow valuation. Not a single one. Not a single one. Not even Warren Buffett. Most investors have picked stocks based on metrics, which might be price. The metrics they use might be price to something that you think of as more bottom line, right? Price to earnings.
Yeah.
Price to book value. You trust accountants. So it's not DCF has never been a model. And there's a reason for that. DCF is time intensive. So let's say you become a mutual fund manager, right? You got to pick 50 stocks to invest in. And you look at your universe of stocks. There are 1,000 publicly listed stocks. Think about the practicality of how the heck do you create a portfolio of 40 stocks? Because if you adopt the DCF route, what do you have to do? You have to value every single one, right? By the time you're done, you got to start doing it all over again because time has passed, the valuations have changed. From a pragmatic reason, people in markets have always use pricing metrics. A pricing metric is something that's it's common sense, because when you compare things across different different assets, when you can't compare the absolute numbers, because I take a small building and a big building next to each other. If I know what you paid for the small building, I can't just take that number and put it in the big building, because the building is so. In real estate, people price per square foot. All pricing metrics are you take what you pay in the market and divide by something that you can scale across companies you're comparing. It could be earnings, it could be book value, it could be revenues, it could be users, it could be subscribers. So rather than think of these as different, think of just them as scaling mechanisms. When you have mature companies, the scaling mechanism can be earnings, because every one of your companies is in steady state, it's making money. When you have growth companies, that becomes more difficult because current earnings might not capture future growth. People use ratios called PEG ratios, where you take the price earnings ratio and divide by the growth rate. But if you have a growth company that's still not making money, then desperation drives you up the income statement and you look at revenues, price to sales.
Right.
But if you have a company where revenues themselves are small, and like Paytm, you have lots of potential subscribers or users, you scale to that. So there's nothing inherently good or bad about what you're doing. It just reflects where in the life cycle the company is. And as I've said, this is not, so pricing has always been the rule. What you're pricing against has changed. So discounted cash flow valuation is really a tool for people who want to build portfolios slowly over time. No portfolio manager can fall into that. It's really a tool, and this surprises people, for individual investors who answer to themselves.
Right.
And I'll tell you why the answer to themselves matters. If you're a portfolio manager and ask you, what's your time horizon? You can give me whatever time horizon you want. But really, it's not your time horizon that matters. Your time horizon is only as long term as your shortest term client. The nature of discounted cash flow valuation is you have to be patient. You got to wait. And if somebody's constantly knocking to say, what have you done for me lately? It's very difficult to wait. So in a strange way, discounted cash flow valuation is designed for if you want to use the word retail investors. I don't like it because it seems like, they're the shallow people, they don't know much. For individual investors who have time as their ally, are willing to be patient, and essentially are willing to accept the fact that they might buy 3 or 4 companies a year.
Right.
You don't buy 30 at a go. You just, and it's pure chance, and you find a company that is undervalued and you add it onto your portfolio. So DCF has always been kind of the exception to the rule. It's a way of thinking about companies that you can convert into metrics, right? So you can say, I have a DCF vision of the world. To me, a good company is this is what makes for high value. Now let me construct a pricing metric that captures what I think goes into DCF value. So from that perspective, you can use DCF to construct better pricing metrics to use in picking companies. But DCF by itself has never been widely used among people to pick stocks because it's, for most institutional investors, you don't have the bandwidth to be able to do it.
Fair point, sir. So the new gen companies, which are more user behavior oriented companies, platform companies, because they keep on changing the goalposts frequently, because their role is to figure out how to monetize their existing users. So they'll keep on trying new ways and means of monetizing that user base. So how difficult it is to create a DCF model for these companies?
Why are you playing on their field in the first place? If you play on their field, they can move the goalposts, they can change the rules of the game, they can put in referees they could do whatever they want, but you chose to play on the field. The first thing to remember in investing is you don't have to play on any field, no matter how green it looks and how good it looks. That is the power you have, right? You can choose when to play. And when you do decide to play, you set the rules. I mean, you can listen to these guys and say, that's all fine, but these are my goalposts for you. And if you don't deliver, you can go tell other people that you'll move the goalposts, but I'm leaving. The power that we have as investors is to recognize that you're never forced to invest in a company. You're never forced to stay in a company. So managers can tell me whatever they want about what the goalposts are, but I'm going to say, look, these are my goalposts. You didn't get there. And by that criteria, you're done. That's what the market does. And you can see that while managers can sometimes convince markets that it's okay to move goalposts, there's a time when markets say enough. You move the goalpost enough. You can't play this game with me. I call these bar mitzvah moments, where the company wakes up and realizes that it's not it's a bar mitzvah is the Jewish tradition when you get to be about 14 or 15, that they take you through a tradition where you now become a grown-up. Companies, when they're young, can get away. So it's like being a 9-year-old. You can break the rules and it's okay because there's somebody else watching out for you. But there will be a point in time where the market says, hey, you've been pushing this user story now for quite a while, but you don't seem to be making any money. You're not monetizing these users. You're not making money. When and how do you plan to do it? And God help you if you're not ready. I mean, as I look at Paytm, what I'm seeing essentially is an inability to change the story. They still seem to think that if they tell a story about more and more and more users, that people will still be excited. But we've got, you've won that game already. You have a lot of users. We know you can get users. 330 million users? That was the easy part. What you've never seemed to figure out is, how do you make money on these users? So until they change the conversation, so they're moving the goalposts in a field that the spectators have all left the field.
Yeah.
They can move the goalposts as much as they want, but nobody cares because everybody's now playing on a different field.
Yeah. So can we also presume that before the company is listed, there are limited eyeballs on the company and investors have better access to the management so they can have one-to-one conversation. But after listing, so many eyeballs are there. So the moment you make mistake, market is going to penalize you badly.
I think that's, uh, I think that's not true, because that would mean that private companies are held to more discipline than public companies, if this were true, right?
Hmm.
And in my experience, that's not true at all. I mean, I live in California, I visit Silicon Valley, I talk to startups and founders and VCs. And you know what? There's absolutely no discipline there either. When times are going well, there is no discipline. That's really the bottom line.
Sure.
Because people assume that they always think everything's like a Disney movie. There's always a happy ending, and you ride off into the sunset because that's what they've seen for long enough. You know when discipline begins across the board, private and public, is when you have a crash and burn.
Hmm.
And that's basically, it's a market's way of reminding you that the nature of risk is not everything comes back, not everything turns out to be a happy ending, and that there are horror stories. So I think the lack of discipline is across the board, private as well as public companies. And it's catching up with some of these companies because there's been no serious questioning. The other thing to also remember with young companies in particular, the biggest risks you run are not micro within the company, they're macro. I mean, what I mean by that is if you're DocuSign, a very highly regarded company,
Hmm.
the fact that Amazon is planning to enter your business can wipe out half your value. This wasn't because you're a good manager or a bad manager. Your entire landscape shifted because a big player entered.
Hmm.
So about 80 to 90% of the risks in these companies come from things you don't control. So what you're judging management on is how well do you adapt to things changing. And I think that that's going to be true for private and public companies. And I don't think there's much disciplining when times are good.
So as an individual investor who's investing in 10, 15, 20 stock, who's used to doing SIP in good quality, high value stocks in India, uh, there is always a question that should I invest in these new gen companies whose business model apparently is not clear to me. So what would be your advice? Like stay away from them, or it's worth it, take a chance?
First, if you invest in 15 or 20 top-notch companies in India, you've
Yeah.
done well over the last decade, right?
Yeah.
Don't look at other people. I
Yeah.
think this is the problem. You always compare yourself to somebody else out there who did better than you. You made a 15% return. That's great. The fact that there are other people making 25% returns, I earlier raised the issue of greed.
Yeah.
There's the other big emotion that drives bad investing, is jealousy.
Yeah.
Right? Somebody else made a 50% return. No, it's like everything else in humanity, greed, jealousy, envy, anger, all of those things will get you into trouble. Well, why wouldn't they? I mean, investing is a very human process.
Hmm.
All your emotions, good and bad, are going to come into play. Now, the place I seek to be in investing is to be serene. Now, accepting, it's amazing. I mean, Indians love to talk about being accepting, but they're among the least accepting people that I ever see, right? They're always saying that could be different. This should be changed. But acceptance of both the good things and the bad things that come to you is, I think, key to being a good investor.
Hmm.
Now, I tell people that the emotions that often get me into the most trouble are regret, where I look back and say, I wish I'd done that, or I wish I hadn't done that, because it's very poisonous. Because once it starts getting into your investment process, it changes the way you invest on other things.
Hmm.
So the fact that you say, I wish I'd know. So there were some people who bought Paytm because they did not buy Zomato.
Yeah.
They
Yeah.
saw everybody else making money in Zomato, say, if only. And then they bought Paytm, not because they liked Paytm, but because they felt that this was going to be the next Zomato. They didn't want to be left out.
Yeah.
I think, if you invest in 15 or 20 good companies, you made a solid return, move on. I mean, what are you complaining about? Now, if you feel that you want to have young companies in your portfolio, do it for the right reasons as an investor.
Mhm.
The right reason is not because they've done well in the past or other people have made money, but because you're genuinely interested in these companies as valuable companies, in which case you're not going to buy them because other people buy them, but you're going to come up with your own way of approaching value in these companies, which might require learning new things, right?
Mhm.
Because the only way you are looking at value is to use a price earnings ratio. That's not going to work here. You got to
Mhm.
come up with your own metric for thinking about value that's not lazy and sloppy. So if you're going to bring in young companies, do it for the right reasons.
Sure. So I want to change the tangent a bit and talk about China plus one story, which is playing well in India right now. At least on the narrative side, there are so many export-oriented stocks doing so good, like chemical, and now textile is doing so well. So, I mean, can you give us more perspective about this China plus one story?
I think China is we're in the midst of a geopolitical shift, right? I mean, we've had a period of globalization where everybody was in the game. It didn't matter whether you were China or Russia. You all jumped in. Everybody traded. Everybody traded with everybody else. It didn't matter where you were growing or where you put your factories. And we're recognizing the dangers of that, because we thought we'd be one unified, but no, that was unrealistic to begin with. Human beings are human beings, and you don't take generations of of warfare and convert them into peace overnight.
Hmm.
So it's true, we're at this point where a lot of companies are looking at their relationships with China and, of course, Russia, and saying this could get us into trouble. This is potentially a problem. We need to shift to a part of the world where we don't have these issues.
Hmm.
About 15 years ago, or not even that long ago, but 7 years ago, I wrote a piece on democracy versus dictatorships. And I'm not a political scientist. I wasn't writing about it from the perspective of, because there's a lot of political science on, democracy. And I was writing it from the perspective of business risk.
Hmm.
And I said, if you look at democracies versus dictatorships, and you ask most companies which system is better to invest
Hmm.
in terms of risk, a dictatorship is always better because they can set the rules and they can keep the rules going for the next 20 years. So the Chinese government could promise you, these are the rules, they won't change for the next 20 years, and you
Hmm.
took it to the bank. In a
Right.
democracy, the nature of a democracy is nobody can promise things for the next 20 years because there's an election in 3 years or 4 years or 5 years, and a new government can come in and can change the rules. So from that very simplistic perspective, it's less risky investing in an authoritarian country than in a democratic country, which was the force that drove China well ahead of India over the last 20 years, right?
Right.
But I said, here's the catch. There's less continuous risk in dictatorships. What I mean by that is there's less day-to-day, month-to-month, week-to-week, year-to-year change in rules. But there's bigger discontinuous risk, which means authoritarian regimes, when they fall, the break is catastrophic.
Yeah.
So when you invest in regimes where you don't have this continuous risk and you think you're not, here's what happens. You think there's no risk, you think there's no risk, and one day you wake up and your whole business model blew up. That's what happened. But that's what's happened with Russia, right?
Yep.
It hasn't happened in China, but what happened in Russia is making a lot of companies, and they've been doing this for the last 3 or 4 years because, since China's been challenged, the question is, are we safe in China? And the Chinese government has not helped in this process with what it's done with its own tech companies. It's shown how much it values control and how quickly it can change the rules if it feels its control is being challenged.
Hmm.
So with this long lead, and that's good news for India, at least in the near term, right? Because it means that companies looking to grow, Netflix is far more likely to invest more in India than China because of this phenomenon.
Right.
Disney is much more likely to jump in with both feet in India than in China because of this phenomenon. So there's this window of opportunity that has opened up for India, but it's got to be careful about how it uses it,
Sure.
because it's not going to last forever. This too shall pass. So there is this moment of potential good news for India,
Sure.
and it's got to play its cards right. But I think that there are legs to that story. It doesn't mean every Indian export-oriented company should be worth a lot. I'd still be picky in my choice of companies. But I do think there's that opportunity that is opening up both for Indian businesses and the Indian economy.
Sure. So yesterday I was talking to a hedge fund manager, and he was telling me in India, the best time to be in India right now is being an entrepreneur, not an investor. Because coming 5 years, 10 years as an entrepreneur, you can build so much wealth. And investor may not be able to outperform the performance which the investor has shown in last 10 years. And he's a big hedge fund manager making that statement.
Has he ever been an entrepreneur?
He has been, and he was not so successful. Now he's trying his luck
I want
again.
him to remember what it felt like to be an entrepreneur, right? It's true. Successful entrepreneurs are clearly going to be more wealthy than successful investors. And they should be, right? You built a business. But there are three things to factor in. One is what percentage of startups failed even in the last decade, which is a good decade. 2 out of 3 fail within 2 years of starting up. So most startups go nowhere. There's a selection bias here, right? Which is when we read stories of entrepreneurs, we're not reading the stories of all those people who took their family and friend money, sunk it into a business and wiped it out. We're reading about the success stories. Second, even among those success stories, it might be worth asking those successful people, what human cost did you go through? Because as an entrepreneur, it's not other people's money. It's your money. It's your time. It's your emotions at play. You work. I mean, entrepreneurs have to work 18 hours a day, 16 hours a day. It's true they're working for themselves, but it takes a huge cost, not just on themselves, but on their families. There's a reason so many entrepreneurs are young men. Young men are among the fancy-free and most footloose people of the population, even more so than young women. Young women already have responsibilities. Yeah. Young men, you're 22, 23, 24. You can do whatever you want because there's nobody depending on you because you've really not had a need. But if it's very difficult to be an entrepreneur when you're 32 or 33. You've got 2 small kids. You've got a family to look after. It's a game for young people. As you get older, it becomes a riskier game. Doesn't mean you can't play it, but you got to be aware of the odds and the risks. Because I think we live in a world where too many people want to be entrepreneurs.
Yep.
It's like the old saying: if everybody wants to be a general, who's going to be in the army?
Yeah.
If everybody's going to be an entrepreneur, who's making the trains run on time? So somehow I think we need to and we also need to stop glorifying entrepreneurs as some kind of Mother Teresa's.
Yeah.
Right. I find this dangerous because we're putting entrepreneurs on pedestals. So just in the last few weeks, I've been watching these shows, and I watched the show on Uber on Showtime, but it's about now Travis Kalanick and how he created Uber. I've been watching We Crashed on Apple TV about WeWork and Adam Newman, and I've been watching Dropout on Hulu, I think, with about Theranos and Elizabeth Holmes. And if you think about them, Elizabeth Holmes, Adam Newman, and Travis Kalanick were celebrated, not just as successful entrepreneurs, but as the pinnacle. I mean, you wanted to be like them.
Yeah.
And what these shows, and if you get a chance, watch them because they're all well done. They show the flip side of the most successful entrepreneurs, which is they work awfully close that line between reality and fantasy and taking advantage of people and taking care of people. To put it simply, the most successful entrepreneurs are not nice people. I wouldn't want to hang out with them too long because they're looking over my shoulder to see what opportunities are coming. And so when people say, well, I should have been an entrepreneur, I think they should be careful what they wish for because they might get it.
Interesting. Very interesting and very straightforward perspective. I can relate the statement with few people I know. Sir, coming back to economics, dollar. So we have seen this massive dollarization of the world, and crypto coming over, and people have been trying to challenge the dominance of dollar. So I need your perspective that are we going to see a different world in coming decade, or is going to be the same story?
I think the word used was perspective. That's what we often lack. You know what the collective value of all cryptos on the face of the earth is? Give me a guess. What do you think it is? So if you take Bitcoin and Ethereum and all the cryptos put together, what do you think their collective value is?
I guess our $100 billion. I don't know. It's just
It's
a
about
while.
2.5 trillion, right? Sounds like a
Oh,
lot of money,
yeah.
but what's a market cap of the largest company in the world?
Yeah, that's almost there.
Apple has a market cap of 3 trillion. So think about
Yeah.
it.
Yeah.
One company has a market cap greater than all of the cryptos on the face of the earth put together.
Hmm.
Then think about how much time and press and articles and books we've read and symposiums and meetings and we've had on just Bitcoin, right?
Yeah.
This is the most absurd overuse of our time. Never in the history, or at least financial history of humankind, has so much time been spent on something so insignificant in terms of its imprint
Hmm.
that I've ever seen. Now, I've looked at Bitcoin for the last 14 years. I know people are very excited about it, but the reality is it's not even a drop in the ocean. It's a part of a drop in the ocean in terms of its place in the global. It's true that the dollarization, the dollarization happened for a simple reason. It happened because after the Second World War, the global economy was in shambles and the US economy was the global economy.
Yeah.
I think, coming out of the Second World War, it was like 50% of the global economy. So the dollarization happened almost because the US was the global economy for the second half of the 20th century. That too shall pass, right? There's no reason we have to be dollarized. It could be some other currency. Could that currency be a global digital currency? I don't see why not. But that global digital currency has to have a central bank of some sort. The problem with many of the cryptos is I've described Bitcoin as a currency created by the paranoid for the paranoid. Because it's essentially built on you can't trust anyone. You can't trust a banker. You can't trust a central entity. That's why you have miners, computer miners, deciding whether you've got enough Bitcoin in your wallet is precisely because you don't have any element of trust. If you think about it, it's like, how we pick restaurants. You go to Yelp and you see what the restaurant reviews are and you pick the best one, or you look at Rotten Tomatoes. This is a crowd testing of a currency. So basically they crowd check your transactions. It's a very inefficient way to actually have a currency, right? Because let's say you go buy a coffee, and the way I check to see whether you have Bitcoin in your wallet is some computer miner has to run through 15 algorithms and guess the right one. And that's okay, you have enough money in your wallet for coffee. This is no way to create a currency. So as currencies, many of the existing cryptos are badly designed. They were never designed to be currencies in wide use. Which means the other alternative for these cryptos is their competitors to gold. Think of why gold has always had this cachet, is when you don't trust paper currencies through time, hundreds of years, and Indians more than anybody else should know this. When you were scared that your rupees were not going to be worth much, what did you do? You converted your rupees into gold or jewelry, and you put it someplace hopefully very safe, and it did its job, right? It held its value. In fact, until the 1950s, I think Indian women could not inherit property. So the way you were able to pass on property was by converting things into gold and jewelry and handing it over. And you know what? That often held its value better than putting it in a fixed deposit in a bank, and inflation kept going up on you. So the other story I've heard for cryptos is millennial gold, that if you're 30 years old, you don't want to buy gold. That's what your father and your grandfather did. And you're young and you want to buy something much more hip. and much more cool, and you'll buy Bitcoin. I'm willing to listen to that story. Okay? But that story comes with legs. If that's the story for Bitcoin, is it's a collectible like gold, here's what it should do. During crises, it should go up, right? Because during crises, you know, and during the last, and it's still young in the process, I don't want to judge it yet. During COVID, you had a big crisis, 6 weeks between February and March of 2020, global stocks melted down. They're down by about 35%. Gold was up 6%. It did its job. You know what Bitcoin did over those 6 weeks? It was down 50%. It behaved like very risky stock. Russian crisis. Initially, both gold and Bitcoin jumped. Gold has held its value. Gold went through $2,000 and it's held its value. Bitcoin's dropped back to where it was before Russia. So far, it seems to be behaving like risky stock, not like gold. So if it's not a good currency, it's not a collectible of any sort. Clearly, it's not something, sometimes you get a collectible because it's aesthetically pleasing. A Picasso, right? Fine art. Why? Because, it holds its value, but you can also hang it up in your house and people admire it. Bitcoin doesn't even have that going for it. In fact, I would argue you've heard of NFTs, right? I mean, board monkeys and all these things that people are buying, which are virtual. I think virtual art has an advantage over Bitcoin because I can put a board monkey on my computer and say, look, I bought that for $3,000. I don't know what people would think of me, but at least I have something. What are you going to show people with your Bitcoin holdings? Look at my Bitcoin. There's nothing to see. It's not a currency. It's not a collectible. Then what the heck are you doing holding it? That's my question to people holding Bitcoin and cryptos is get your story right. And if you're honest, you know why you're holding it? Because you think you can flip it to somebody else at a higher price. There's nothing more, nothing less. And that's a setup because sooner or later, somebody's going to say, it's like the emperor's new clothes. They're going to say, what the heck is that you're holding? Yeah. You're going to try to describe it and they're going to say it's worth nothing.
Sure. So clearly this discussion gives me an alternative of dollar as gold, which has been the case. So if at all I have to
but remember, it didn't have to be an alternative, right? Because until 1971, every currency in the world ran on the gold standard.
Yeah.
In fact, through human history, gold has been the currency more than any physical currency, right? Because when you have a gold standard, because you don't want people carrying around gold, right? Because it's a very dangerous thing to do because it's not. Now, how do you break down enough gold to buy a cup of coffee? It's not a practical. So gold standards essentially tie currencies back to gold. So that wouldn't be unusual. In fact, you can argue that's been more true for many currencies through history than what we have now, which is currencies backed up by central banks.
Right. So, sir, since we're talking about commodities, let me just, quote an article which I read 1 or 2 days ago that earlier currency used to be the primary way of fighting an economic war, and now commodities has become that primary source. I mean, look at what is happening.
Very, very anecdotal evidence. The reason commodities are the ammunition you're using here is because it's Russia.
Yeah.
When you think about Russia, it's a military superpower, though we don't know how much of a superpower it is given how much trouble they seem to be having in Ukraine. But it's as an economic power, it's like 2% of global GDP. It's a tiny slice of global GDP, but it's always punched above its weight in commodities: oil, gas, coal, iron ore, nickel. That's really the core of the Russian economy. Is it's commodity based. So if you want to squeeze Russia, of course it's going to be commodities you squeeze it on. What else are you going to squeeze it on? It's not technology. It's not manufacturing. It's commodities. But I know that we don't want this to happen. God help us if it does. But I said, when people talk about this and they talk about, look how well companies are behaving, they're pulling out of Russia because Russia is a bad country. I said, let's play a little thought experiment. If China had invaded Taiwan, and you did everything you did in Russia, you think it's going to work there? You can't squeeze China on commodities because they control the supply chains for all of your manufacturing companies. They cut off those supply chains. You're not going to get your iPhone and your furniture from IKEA, and so. And second, I'll wager that these companies that are so quick to leave Russia and talk about how good they are wouldn't be as quick to back out of China. Why? Because 30% of your sales come from China. So I think that this is the problem when anecdotal evidence in general is used to set policy and narrative. We learn the wrong lessons because we look at a story and the lessons might apply to that story, but then we generalize.
Right.
So what you've learned from Russia is not going to help you if the next country that you're looking at is China. It's a very different battle. It's going to be a much more, there the pain is going to be on both sides. If you want to hurt China, you got to be willing to hurt yourself. That's a reality.
True.
You can hurt Russia with doing relatively little damage to yourself unless you happen to be one of the European countries that gets a lot of gas from Russia, right? Natural gas, because it is, I think, 40% of the natural gas in parts of Europe come from Russia. So I think it's relatively easy to sanction and squeeze Russia. It won't be as easy to sanction and squeeze a country which is larger economic power and draws its power from different sources.
True. Sir, I want to come back to economics. I know I have limitation of time, but please allow me to ask you 2-3 more questions.
Sure.
Sir, inflation is a big concern right now. Everyone is talking about it. People are writing about it. And, overall, people who are there in the market, they want to float that narrative in a big way so that markets fall. So my question is simple, sir. Is inflation good or bad?
If you had inflation that was high and stable, we'd learn to live with it. You know what I mean by that? If I told you inflation is going to be 10% a year forever, and I guarantee it's going to be 10%, we'd all learn to live with it, right? The companies would set their prices 10%, your wages will be indexed to inflation. The problem with inflation is that when it gets high, it also gets unstable.
Yeah.
In other words, when inflation is 1 or 2%, it moves in a very narrow range. When the expected inflation is 10%, here's what you get. You get 1 year with 14, 1 year with 6, and that's deadly for everybody. Think like a business person, right? I ask you, and let's say you're a manufacturing company and you want to build a plant that's going to produce for the next 30 years. You got to make an investment decision. And you're not sure whether inflation is going to be 14% or 6%. Somebody tells you the expected value is 10%, but the expected value is kind of meaningless, right? Because the outcomes are going to be that variable. You go out and build this plant on the expectation inflation is 10% and it turns out to be 14%.
Right.
You're ruined. So what happens when you have inflation is people start to think short term. People don't make long-term decisions. In fact, when inflation gets really high, you get hyperinflation, all investing activity stops and everybody becomes a bank. Right? You lend money for 3 months or 6 months because nobody wants to lock their money in for the long term because you could get really demolished. So if you look at the history of economics, high inflation has never been good for businesses, never been good for investors. Not because it's high, but because it's high and unstable. You're saying, can't we make inflation high and stable? Really tough to do, right? Because it is going to shift over time. So I think that inflation is a real and present danger, but why is anybody surprised? I mean, we've had governments spending money like drunk sailors, and I'm insulting drunk sailors when I say this, for the last few years. And the problem is they don't seem to want to stop. Inflation is always ultimately, when you get high inflation, is ultimately a monetary phenomenon. You're just spending too much and printing too much money to back that spending.
Right.
It's going to catch up with you. It's the laws of economics finally catching up with you.
Right.
So I think there's no doubt that inflation is high now. There's also no doubt that some of it is transitory, right? Supply chains coming out of COVID. But some of it is permanent. There's no way anybody can tell me that inflation now is going to go back to where it was pre-2020. The question is, where will it end up? And that's really what markets are wrestling with now. Will it end up at 3% or 6%? It's going to make a huge difference to investors where it's going to end up. And what I say about the US dollar applies to any currency, because inflation is a currency-specific phenomenon.
Right.
No, it's going to apply to any currency.
So then how does a typical household protect itself from high inflation?
Well, you need to have at least much more of your cash in liquid and short-term holdings that you can roll over and earn kind of the short-term rate, right? Indians used to do this all the time. You used to put your money in fixed deposits for the next 6 months. When inflation in India, going back 25 or 30 years, inflation was 8, 10, 12%. That was part of the game. And you probably should shift your money from financial assets to real assets. The only problem is, where do you go, right? If you think about real estate, it's been pushed up as well. There are fewer sanctuaries from inflation than there used to be 40 years ago. In the US, in the last round of high inflation in the 1970s, only two asset classes held up their value. One was gold, but gold can't be a primary asset class. It's not, because it produces no earnings, no cash flows. The other was real estate, because in those days, real estate was an asset that moved almost independently of financial assets. So the price of your house and the value of your stock portfolio, they moved up and down, but they didn't move together. But we've ruined real estate as an asset class by securitizing it. And by securitizing it, you know what we've done? We've made real estate move a lot more with stocks and bonds. You saw this in 2008, right? Your stock portfolio collapsed, the price of your house also dropped. And that's not a good thing, because I'm not sure where you go. Inflation is high and unstable. There's no safe sanctuary. And I think all you can do now, what I would tend to do is, if I'm investing, invest in companies that have pricing power.
All right.
Right? Because if inflation is going to be high and changing, you want companies that can adjust their prices accordingly.
Right.
So I would go to companies with pricing power, strong brand name companies, commodity companies, for instance, eventually can pass prices through. So kinds of companies that can pass prices through, you don't buy an airline. Right? I would never buy an airline to begin with, but an airline is a prototype of a company you would design if you wanted to demolish it with inflation, right?
Right.
Because your cost structure is based on fuel costs, which are going up 8, 10, 12%, but you're in an incredibly competitive space where it's tough for you to raise ticket prices. So any company which is in a competitive marketplace can't raise prices, I would steer away from, because they're going to get squeezed.
Right. So now that we are talking about it, so, can I get some themes like inflation-proof sectors? That these are the sectors which are typically...
There's really no inflation proof. I'll tell you what I've done. I mean, I now own 5 of the 6 FANGAM stocks: Facebook, Amazon, Netflix. Other than Netflix, I own the other 5. Facebook, Amazon, Google, Apple, and Microsoft. Why do I own them? First, they are companies with incredible pricing power. And I can tell you personally how much pricing power they have. I have Amazon Prime.
Yeah.
They charge me $119. You know what? They could charge me $319 and I'd still pay it, because I'm so dependent on Amazon Prime. You take the same thing with Apple. I paid, I swapped my iPhone, but it's $1,000 device. But I said, why don't you just go to a cheaper Android phone? Apple has hooked me into its ecosystem. I have so much of my life in the Apple ecosystem. So cutting to the chase, these are all companies with significant pricing power, and also companies which have financial strength. They have almost no debt, and each of these companies sits on $100 billion, $150 billion in cash. So I'm not saying these companies will not be unaffected, but if inflation is bad, it's going to wipe out even the little competition they have. This is one of the things to think about. When you have shakeouts, sometimes holding your strongest companies to the shakeouts means when you come out on the other side, your company is even stronger than it was going into the shakeout. So in a strange way, I think that the big tech companies make my criteria for being having pricing power. They have low debt. They have lots of cash, and I know they can live through a financial shakeout. So that's what I would think about: is look at your universe of stocks, and you might end up with a portfolio that looks very different than the one you have now.
Sure. So, but what about valuation? I mean, do you look at the valuation
Yeah, I
or?
valued all of those coins, but what I said, the pricing power is going to show up in the valuation, right? It's going to mean their margins will. I mean, everything ultimately shows up as a valuation input. They're able to maintain their margins. Why? Because they have pricing power. If you don't have pricing power, the way it shows up is your margins get squeezed as inflation goes up. So I think that if I were valuing United Airlines or Singapore Air, I would not be willing to leave margins where they are. They're going to get squeezed as inflation goes up. So I'm much more exposed with those companies.
Right, sir. So if I take some Indian examples, probably Reliance, because they own such a big pipe to our household now, and they definitely, because of the industry structure now, they have the pricing power. So could be one of those stocks in India.
I mean, I think Reliance is a conglomerate, right? You're buying a bunch of companies. Petrochemicals is still the cash cow that feeds every other business that they have, right? Right. So the other businesses are more growth plays, and it's true they're willing to lose a lot of money as long as their core cash cow keeps giving. Reliance is solid.
Yeah.
Right?
Yeah.
But it's not that every business they're in is a cash cow, right? Geo is a huge money loser, but they get building this immense platform that supplements all their other businesses. So I think that Reliance is actually you're buying, I mean, any family group company, you're making a joint bet on the company and the family running the company.
Right.
And that's, I think, one of the things you have to be concerned about with family group companies is things like succession. Right? When I buy Apple, I'm not sitting there saying, what does Bob Iger's son do? I'm sorry, what does Tim Cook's son do?
Yeah.
Oh, because I don't care what he does, because it's not like he's going to become CEO. But with the Ambanis, remember the pain, the drama that went around when Mukesh and Anil had their fight. That's a feature of family group companies, is worrying about succession battles and how will this company. So you're making a bet that if you're buying Reliance, you're not just buying a good company now, but one with a succession plan in place that if Mukesh decides to hand over the reins, or if God decides to make him hand over the reins, because you don't always control when you hand over the reins.
Yeah.
Now, where does so with family group companies, you have to think about what have they built a professional. To me, the essence of a good family group or a good founder is you make yourself dispensable.
Right. So, but in India, because India 60% of stocks are still owned by the promoters and 20%.
Yeah, but I think some promoters are much more willing to let managers make decisions and not second guess them. And some promoters are they claim to allow managers to make the big decisions, but they have veto power. Right? So you can be family owned and family controlled, but it doesn't mean you have to be family run. And I think the healthiest family groups in India are the ones that recognize that they've got to give up control. This is the nature of public investing, is you got to trade off less control for perhaps a better company, a more valuable company. And to me, with some family groups, when posed with that choice, would you rather have more control or a more valuable company? There are some family groups in India that says, would rather have more control.
Yeah.
And I think it's human nature. Again, I don't think of it as a good thing or a bad thing. It's, I understand your family name is in the company. You don't want it to leave the family. But you chose to go to the public markets. You chose to ask for other people's money. You can't continue to stand behind the shield of this is my company. This is now our company. I am a part owner of the company. The fact that you started the company and your name is on the company gives you more power, obviously, than me, but we're both owners. I think the best family groups recognize that when you go public, you created a partnership with other shareholders.
Right.
And you got to treat them with respect. So if I'm investing in a family group company, I avoid family group companies where the family doesn't treat shareholders with respect. It doesn't treat them as part owners. It treats them as capital providers.
Right.
And that's very cynical. You want my money. You don't want my input.
Right. Sir, I have a last question, which I always wanted to ask you. How do you incorporate these qualitative aspects related to a company in a valuation model?
Name one thing that you thought was qualitative. Give me one example.
For example, management, family allowing a management to take over the operations of the company.
When you value a company, especially if you're doing discounted cash flow valuation, it's not about next year. It's not about 2 years from now. It's a present value of your cash flows over the rest of your life, right? So if you have a company with strong corporate governance, if you're earning less than then you should be earning. You're in bad projects over time, I assume you'll fix it. If not you as the management, the management will change because shareholders will bring a different management team. So as I push out the numbers into the future, I improve your numbers. Your margins will go up. Your debt ratio will come down. Why? Because if you don't do it, somebody else will make you do it, or there will be. But if you have a company with poor corporate governance, the family is running the company, they've run it badly, but they seem to be in complete denial. You know what I'm going to assume? You control the company. You run it badly. You don't seem to realize you're running it badly. Why should I assume that you're somehow going to come to your senses and do things well in the future? So when I project numbers in the future, I assume that you will keep ruining value. You'll keep doing bad acquisitions. You'll keep taking bad projects. And guess what I'll get as your value? A fraction of the value that I got for the first company, which started with the same set of numbers.
Okay.
But where I assumed that improvement would come over time.
Sure.
Conversely, we have a great management team, but it's coming from a person. You got a CEO who's dynamic, who's going out and getting clients, and every client is connected to that CEO. What my fear is? That 5 years from now, he's going to fall over with a heart attack. And then your returns are going to magically collapse because when your CEO left, all the clients, he built a personal network, not a business network. So when I project out numbers for that company, I'm going to, when I get to my year 5, year 10, I'm going to bring the numbers down to industry averages, saying once this guy leaves, you're going to just become an average company.
Right. Yeah. Got it. So it all gets incorporated in the projections. That's what you're saying.
It has to be in the numbers. If it's not in the numbers, you're wasting your time talking about it. Now, I encourage people when they get into companies, don't get distracted by stories. Use stories to focus on the numbers. So every time somebody tells me a story about a company, the question I'm asking is, where will it show up in the numbers? What kind of? So they talk about how loyal their employees are. First, I say, show me the money. You know how it should show up, right? If you have loyal employees, you should have lower turnover rates than other companies in your group. And you know what? 90% of the time when companies claim they have loyal employees and they look at the turnover rates, their turnover rates are higher than... First, people make up crap. They make up competitive advantages that they don't have. We have a brand name, really? If you have a brand name, your margin should be higher than the competition. So first, dispense with the stories that really have no basis, because sometimes the numbers are enough. But if they have a story that has legs, then I'm going to bring it into the numbers. And it'll make both of us better, because it'll make my valuations better and make you better at kind of assessing, if this is your competitive advantage, you have a loyal workforce and it's showing up as lower turnover rates, I've now given you a metric that you should probably be keeping track of over time. Because if that turnover rate starts going up, your core value, core advantage is starting to dissipate. So often storytellers think I'm trying to be cynical. I'm trying to, break their story. I'm not. I'm trying to strengthen their story if it has a basis, but I'm going to rip it apart if it doesn't.
Fair point, sir. Sir, it's an absolute pleasure. I don't want to close this, but I know that you gave me this much time. So I'm very excited, whatever time you have given to me. Thank you so much. This video has clarified so many things for me, and I'm sure my learners are going to be very excited. And guys, I'm going to post the link of Sir's YouTube channel also below the video. Please follow him, listen to him. you'll make, you'll become a better market participant for sure. So thank you so much. It was my pleasure to
It's
interact
my
with you.
pleasure too. Thank you.
Thank you so much, sir. My goodness, I knew exactly I'm going to get a lot of value out of this, and I'm sure you must have received that content which you wanted. So now how to value a company, an old school or a new gen, you know exactly what to do. So read his books, follow him, read from him, learn from him. I'm sure you'll become a better market participant. We'll record more such videos. Thank you so much. Till then, bye-bye.